Okay, so hello, my dear future chartered accountants. Hope everybody is doing great. First of all, can you please confirm that my voice is audible and the PPT is visible? Yes, thank you. So, in the previous session, we discussed about, or previous sessions, we discussed about the foreign exchange risk management. Now, this chapter is an extension of that. So, don't get relaxed that foreign exchange chapter is over. Uh, this chapter also could have been asked in the previous chapter, but somehow it has some more theory concepts and some more variety of problems which requires understanding of the foreign exchange risk management chapter. So what kind of questions you'll expect here? What type of problems you can expect in this area? Okay, you have to understand certain basic terminologies. I will not spend much time. I'll quickly run through it. Like we have FDI, FII, foreign direct institution, foreign institutional investors, or foreign direct investment, FDI, foreign direct investment, FII, foreign institutional investor, and now they're called as actually FPI, foreign portfolio investors. So basically, the difference is FDI people are long term people. They come to India, they start a company in India. Like Microsoft has a company in US, they start a subsidiary in India, they start a company in India with some percentage of ownership. Microsoft India, that is FDI. FII, FPI people, they keep buying the shares of Infosys share, TCS share, HDFC Bank shares, and they sell it also. That is, they, like you and me, buy in the secondary market, in the stock exchange mainly. They are called as foreign institutional investor or foreign portfolio investor, where their goal is not long term and their goal is short term, and they are not interested in day to day operations. Anyway, that is regarding FDI, FPI, that you don't worry much. Then you will have this one thing called as ADR or GDR. Even questions in the exam, they will ask you like this. Okay, so what type of questions you can ask? Just try to understand. So this chapter, International Financial Management. Here, basically, we talk about two types. Some companies coming into India and starting their business, or some companies going outside India and starting their business. Broadly, we'll have two types of problems. Or I'll say, overall, I have seen four types of problems in this chapter. Four types of problem, broadly. First type, a problem on ADR or GDR to be specifically, Global Depository Receipts. About pricing and cost of GDR, like cost of equity, cost of debt, cost of capital, cost of GDR. They will ask you a question on this. And the next variety is a foreign company coming into India. Foreign company coming into India. Broadly, here you will have one type of problem which are capital budgeting problems. We calculate NPV. The other is like a starting a subsidiary. That is, a company will be the holding company as well as they will be, uh, what do you say, a seller. They are the customer. So they are a holding company and they will be a customer. A problem like a transfer pricing problem. They start a unit in India, they produce the product, they only purchase and then they sell it. So question will be, should they sell it directly or should they come to India and take it, make the production and then go there and sell it to, in the US. That is what you'll have one time question I've seen. And then Indian company going outside India, Indian company going outside. Here typically we have two methods actually. We discussed little later. One is cash flow in foreign currency, and then you convert it to rupees, but the question can be in cash flow in rupees, or we express ultimately cash flow in INR terms, local currency. FC is foreign currency, cash flow local, LC local currency. Cash flow in foreign currency or cash flow in local currency. We have two methods, but only one problem. Ultimately, we are going to calculate NPV only. Ultimately, we are going to calculate NPV and we decide whether the project should be accepted or not. And one more area of questions what I've seen is surplus fund management problems. This will be like a company will have their head office in US, a surplus fund management or treasury management, you can say. Treasury management. So they'll have a surplus fund in, let's say, they are having office in London, but they can invest the money in London only. They can invest the money in US, or they can invest the money in France for 3 months kind of thing. So where the investment is better, which investment gives the highest return? Surplus fund management, treasury management is one type of questions that I've observed. Okay, so let me talk about the each individual about at least 5 minutes each. Then we'll go further. So first variety of small questions, what you will come across, questions only are focusing, that is on GDR or ADR. DR stands for depository receipts. How this works, quickly I will tell you. This is basically applicable for an Indian company in India, they want to raise money outside India, let's say from USA. So they want to raise money outside India. They want to raise the capital not from Indian investor but from foreign people. So what they do, the company in India, they will issue the company shares, or at least they will deposit shares. We call them as custodians with people. For example, SBI. We have more popular, Infosys shares gets listed in USA. HDFC Bank shares gets listed in USA. How can you call like that? That means their Indian shares are not listed. Their equivalent deposit receipts are listed. How it's going to happen? Quickly I'm telling you. So company in India give shares or issue shares to custodian. For example, SBI. And what they will give, they will issue. So these people give shares and these people issue DRs, depository receipts. For example, one deposit receipts equals to like 3 shares, something like that. Example, they will issue to a custodian in USA, or for example, let's say some foreign bank. They are custodian there, and they will issue the deposit receipts. They will issue the deposit receipts to the US investors or US citizens. So when you say that Infosys is listed in a New York Stock Exchange, Infosys shares are not listed. Infosys depository receipts are listed. And when you convert it to deposit receipts, they will convert from rupees into, let's say, dollars. So one deposit receipts are represented in dollar terms. So you will also have exchange rates. So whether they are eligible, they are not having shares. They are having deposit receipts. Now, do they have voting rights? All those things you learn in law. I don't want to confuse you further. This is the basic structure of deposit receipts. When an Indian company wants to issue the share to a US citizen, they take the route of depository receipts. So when a US investor purchase the deposit receipts of Infosys, let's say, they become the shareholders of Infosys. So if Infosys share price goes up, then we say that the deposit receipts also will go up. And dividend if company pays, they will also will get it. But only thing is, this will also be converted into exchange rates. So this deposit receipt rates is influence of two things. One is the number of shares you have and the conversion rates. For these two reasons, the DR will fluctuate in the US stock exchange. So this way, a US person can become investor of Indian companies. An Indian company, if having a good brand, good name, they can raise the money even from outside India. What is ADR? It's listed in American company, I mean non-American company listed in American company, Infosys in America. Non-American company coming into America, that's called as ADR. And if they go elsewhere, but expressed in dollar term only, that's called as GDR. So both are very similar. Don't confuse yourself much. Okay. Now, what type of question they will ask in exam? They will ask you an Indian company issuing funds outside India, and what are the things to be kept in mind. So you should know what is the cost of one GDR or one ADR, depending on what number they give. One GDR will be whatever is the market price per share, like Infosys 2000 rupees into number of shares divided by, because you say $1 equal to 60 rupees, so this rupee will be right hand side. So to convert into dollar terms, you divide by the exchange rate, you divide by the conversion rate. So this will give you 1 GDR expressed in dollar terms. Then they'll ask you how many GDR to be issued, number of units to be issued, number of GDRs to be issued. In that case, you are going to do issue size divided by 1 GDR. It's like total amount divided by per unit will give you number of units. But sometimes what will happen on the issue size, there will be issue expenses. They say we want to raise the 10 crore, but issue expense only will go for 1%. So if I raise 10 crore, 1% will go off. I need 10 crore. So issue size will be, or whatever the amount required, this issue size. Or if amount required will be more, then you should do amount required divided by 1 minus expenses, initial expenses in percentage. So this will give you the issue size, then divided by GDR, 1 GDR will give you the number of units. Then they'll ask you cost of GDR. Cost of GDR, this you should use dividend discount model, which means a dividend at the end of the year divided by whatever 1 GDR equals the cost per GDR, plus growth rate. And dividend also, please remember, you should take the dividend per share into number of shares divided by exchange rate, because this has to be expressed in dollar terms. And 1 GDR is what is cost of 1 GDR. 1 GDR means this, cost. This is 1 GDR, whatever, 1 GDR price, the price of 1 GDR. Price of 1 GDR. So dividend divided by price of 1 GDR. This is the formula, you know, right? Cost of equity equals D1 by P0 plus G. The dividend discount model simplified like this. You would have learnt even in IPC level. D1 by P0 plus G. Dividend expected at the end of the year divided by current market price plus growth rate. Same thing you do for ADR, GDR. Okay, so this is what you will get, one type of problem that is on ADR, GDR problems. Okay. Second type what you get is foreign company coming into India. Foreign company coming into India. Okay. Now in this type of questions what you have to do is it's purely capital budgeting problem. So what type of question you'll expect here? They will tell you we are having very good response from the products which we are selling in the India. So should we continue to import from our country? I mean, should we continue to export from our country to India, or should we start a unit in India itself? So the problem will be, or options will be, two varieties. That is continue to export to India, continue to export. For example, we import a lot of clothes, let's say imported clothes, Nike or this Reebok or shoes, all those things. So one, they can keep on importing it. They can have their stores, manufacturing units in England, in UK and all, or in US. Or they can come to India, start like FDI. They start a unit in India and start selling in India. So when it's continue to export, other is start a subsidiary in India. So what you should do is you have to calculate sales here, continue to export. If you do it here, obviously if you come to India, if you start a subsidiary, you'll have more number of units, you can sell more. Selling price per unit may be same, that will be important. Selling price per unit will be same, selling price per unit will be same. But because the selling price, customer will not know whether it's manufactured in India or it is imported to India. They will just know, okay, this is what is from this brand. That's what is important. So selling price per unit will be same, but number of units will be different. You subtract a variable cost, you subtract a fixed cost, you subtract a depreciation, you get cash flow before profit before tax, you subtract tax, you add depreciation, then what you get under two situation is cash flow after tax. And we don't take individual cash flow after tax, we take incremental cash flow differential after tax. This is CFAT, incremental cash flow after tax. But to start a unit in India, we'll also have to have a investment. So you will have a, like a purchase of machinery, purchase of plant. So you will have an initial investment. So initial investment to start a subsidiary in India, how much machinery cost, plant cost, like that, and incremental cash flow after tax. But incremental cash flow will be every year. So to bring it to present value, I multiplied by annuity factor. This will give me present value of all inflows. So initial investment will be outflow, present value of inflows, net I am going to calculate NPV. And here, one more thing to be kept in mind. Now here initial investment you will have, therefore you will have some terminal investment as well, terminal cash flow. And I always tell you, when the problem is bigger, remember three aspects: initial cash flow, interim cash flow, terminal cash flow. Initial, what happens at the beginning, IIT, what happens at the beginning, initial, what happens during the project is alive, interim, here I am calling it as incremental, and terminal cash flow. What is terminal cash flow? When the project is completed, initial investment you will have. So for initial investment you will have scrap value, the if the asset is there, machinery, plant, building and all, scrap value will be there. So that should be multiplied by discounting factor. Why discounting factor? Because that comes only once. So we have initial investment. This is one cash flow. This will be outflow. And we have present value of inflows, which is the incremental cash flow present value, and terminal cash flow, this one, which is scrap value into discounting factor. When I multiply by discounting factor, also I get present value. And here is what I get: NPV. And you know the decision: if NPV is positive, project should be accepted. If NPV is negative, project should not be accepted. In this course, few adjustments will come. One of them is working capital. Now, working capital is also an investment because amount is blocked when the project is alive. Therefore, initial investment, along with that, you should also take investment in working capital. Investment in working capital. Amount is blocked. You take an investment. And when the project is completed, you will recover that money fully, not like a scrap value. Therefore, when you say terminal cash flow, this will be scrap value plus working capital recovery. Working capital recovery. So when you invest in working capital, it will be an outflow. And when the project is over, the working capital will be an inflow. This is actually, you don't lose anything, right? See, this is, for example, minimum bank balance to be maintained. You will have a bank account. You have to maintain a minimum bank balance. So in that case, uh, they will tell you have to maintain 10,000 rupees. So when you open an account, you have to keep 10,000 rupees with them. For example, current account. It does not earn an interest also. And when you close the account, the 10,000 you can withdraw. So as long as the account is alive, As long as the project is alive, that current account 10,000 minimum balance is actually not going to give any benefit. You lose the opportunity cost. So in the initially the 10,000, when you open an account, you have to give. It does not generate any income, any interest, and when the account is closed, that amount you withdraw. That is what exactly happens in working capital. When you start a project, you keep the money for day-to-day purposes, working capital investment, and when the project is over, that will come to you as a recovery. Effectively, you lost time value of money, but we don't want to do any shortcut calculation. So initial cash flow, working capital will be investment, will be outflow, and on terminal cash flow, the question may not specify, but it is understood that the working capital, when the project is over, working capital will be recovery, full amount. Whatever you invested and plus additional investment if you made any, exact amount you get, no scrap value and all. But initial investment is in present value terms. But terminal cash flow is in future value terms. You should multiply by discounting factor. So what do I do? Scrap value is terminal cash flow. Recovery of working capital, implied adjustment is also terminal cash flow. So both of them put together, I multiply by discounting factor, I get present value. And one more thing they will have to keep in mind, the working capital, you should take only incremental investment. Recovery also incremental. Why incremental investment working capital? You're already doing some export in India. You have some working capital, let's say 20 crores. Now, when you start a unit in India, you require 50 crores. So, you will not have both, right? You will not be doing export also, you will not be doing subsidiary production also. So you need only incremental working capital. So initially also you take incremental working capital, and on terminal also whatever the same thing will be working capital recovery. And if NPV is positive, the project should be started in India. Subsidiary should be started in India. If the NPV is negative, then don't start a subsidiary in India. Continue to export and make profits and make cash flow based on that. Okay, this is one variety of question you will come across. Foreign company coming into India. Then you have one more variety of foreign company coming into India, but one more variety. Okay, this is also situation, foreign company coming into India, but where they are the holding company, the foreign company will be they are the investors, means they are the holding company as well as customers, as well as customers. So what are the two choices they will have in this type of variety of problem? They will have two alternatives. One alternative is produce in their country. For example, I'll take US as the example. Produce in USA and sell in USA. They are only produce, they are only sell. Or second alternative, what you have, you start a company in India, produce in India, and then sell in USA through export. Sell in USA. So obviously, wherever your profit is highest, that you would like to select. Or you see both case you are selling. Uh, so you're only going to calculate wherever production cost is least. That you also you can do anyways. So if you produce in USA, if you produce in India, you can either compare with the profitability terms or you can compare in terms of cost, wherever the cost is cheapest or wherever the profit is highest. Both ways you can make a decision. Okay, so here if you are selling in USA, then you do whatever your sales value minus whatever cost of production. Both are in dollar terms. cost of production. Both are in dollar terms, therefore difference you will get in profit. And these type of questions will be relevant for 1 year only. Okay, now here what will you do? If you produce in India and then sell it to USA, sale value will be in dollar terms. Sale value will be in dollar terms, but the purchase price is not going to be straightforward. Cost of production. This is where you will have some challenge. How do you calculate this cost of production in dollar terms? Because you start a company in India. You understand the process? How, what you're trying to do? Okay, let me just tell you. If you start a company in India, if you want to produce in India, so what you do is you start a company in India. You start a company in India. So if you want to start a company in India, first of all, you have to invest. Correct? You have to invest. You should invest in the capital, cap structure, and machinery and all. You start a company in India, then you produce. Means you pay rent, you pay salary, you pay other expenses like that. And then this you export and you pay tax also. Remember, you export to yourself. Means you pay rent, you pay salaries, you pay other expenses, you pay tax. There will be income tax, there will be withholding tax, there might be dividends, any of those dividend tax. Then you export to yourself. Means from India, it's export. But for you, US person, it's going to be like you have investor and you are also a customer. So this one type of will be there. So the export cost, the export cost at what rate, transfer pricing, what you call the export cost, what you say transfer pricing will be the import cost for US. So this will be the import cost, or for your terminology like a transfer pricing. TP, transfer pricing. I'm sure you must be expert in income tax and all. Import cost, right? For Indian company, it's export. Like they'll tell you cost plus sales also. So you take all the rental cost, salary cost, all other depreciation cost, whatever all the cost, you add some profit, subtract tax, whatever the sale value you get, no, that cost plus profit, if they say the sale value, that is going to be your cost of production. But you are a customer, so you're purchasing this, so cost of production. But you're also investor, so being an investor, you get share of profit. So this cost will be subtracted by the profit or share of profit, whatever profit, as an investor, or dividend as an investor. So you'll get net cost. Cost of production will be the import cost, which is cost plus sales, minus the profit as an investor, as a shareholder, net cost, then sale dollar value, wherever the balance amount is profit. Or you can do profit, one more calculation also. Sale value minus import cost, that is cost of profit, that is a profit from the production, and profit from being investor. So both the profit you can add. Here also what I'm doing, minus and minus of minus. So it will be plus only ultimately. Anyway, so this is one structure of problem which you can expect. Foreign company coming into India, start a unit in India, and you export yourself, being yourself a customer. So the export sales of the company is your import cost. Cost of production will be the cost of export for the company, that is your import cost. But you are an investor also, so you will have some profit, dividends, after all taxes, regular income tax, dividend tax, withholding tax, TDS, after all tax, what inflow you get, profit as an investor, that is your inflow. Cost of production, import cost is outflow, so you calculate the net cost, sale value minus net cost, that profit versus the previous profit, what explained here. You choose wherever the profit is highest. So choose the option with highest profit. Choose the option with highest profit. Okay, so this is another variety of question you can expect from this chapter. Okay, next. Like now we have Indian company going outside India. Indian company going outside India. Indian company starting a unit in USA. Indian company going outside, going to foreign investment. Indian company making foreign investments, not foreign people coming to India. Ultimately, we have to express in straightforward thing. We have to calculate NPV in rupee terms. But we have two routes, two methods to calculate NPV in rupee terms. One method is cash flow in foreign currency method. Cash flow in foreign currency method, method 1. Or second, cash flow in local currency method. That is rupee method, local currency method. Why these two methods will apply, I'll tell you. Logical. First, you are starting a unit, let's say in USA. You go to USA and start a branch. Let's say you start a hotel, you start a restaurant. Now customer will come there, will sit, will they tell you, oh, you're Indian company, you're providing Indian foods, we'll pay you in rupees? No, right? All the transaction there will take place in dollars only. So you will have all the foreign currency investments, foreign currency cash flows, NPV also will be in the foreign currency. So here in this case, your investment, initial investment will be in dollar terms, foreign currency. Interim cash flow, interim cash flow will be foreign currency. Terminal cash flow will be in foreign currency. Therefore, NPV, when you consider all of them, investment, interim cash flow, terminal cash flow, investment already in present value terms. Interim cash flow, I'll have to multiply it by annuity factor. That will give me present value. And terminal cash flow, I'll multiply it by discounting factor. I will get to present value. And when I consider all of them, all the things together, that's what I get NPV in foreign currency terms. Then I multiply it by spot rate. That's what we'll get NPV in local currency terms. Initial cash flow in foreign currency, interim cash flow in foreign currency multiplied by annuity factor, you get present value. Terminal cash flow after the project is over multiplied by that year discounting factor, only 1 year. So discounting factor you multiply, you get present value. NPV, therefore in foreign currency terms multiplied by spot rate, you get NPV. What's the problem? Simple, right? There is one catch. What is that one catch? For this discounting factor and annuity factor, you need the rate of discounting, right? You need the rate of discounting, and that should be risk adjusted discounting rate. That should be adjusted rate. Risk adjusted rate. That should be adjusted rate. What is this adjusted rate? An Indian company, an Indian person, remember a starting point is Indian company going outside India. So in Indian person going outside India, final answer has to be from Indian investor point of view. His required rate of return when he is in India and his required rate of return when he goes to US, it will not be same. Why is that? You are an Indian. You deposit money in rupee terms in India, you will have a fixed deposit. How much rate of interest you will expect? FD interest 6%, sir. 6%, 5%, 5.5, 6%. But you go to US and put the FD in US, you put the FD in US, do you think you will expect 6% returns? No, you will expect only 1 or 2%. The risk-free rate in two countries are different. Risk-free rate in two countries are different. So when risk-free rate is different, if you're doing a project in India, suppose you expect 8% return risk-free, I get 6%. 2% extra as a risk premium I expect. Now in US also can you expect 8% return? No, there also same logic should hold good. 2% premium. So if you have 2% FD rate plus 2% premium, 4% you'll expect. Are you getting my points? I'll write for you. So for Indian person, for Indian, when you do this in India, business in India, and you do same business in foreign country, same business in USA, let's say, same business in USA, example I'm giving, the required rate of return will not be same. The required rate of return will not be same. Required rate of return will be different. Required rate of return will be different. What is the logic behind this? Logic I will tell you. Suppose in India, FD rate, I'll say risk-free rate, FD rate is 5%. And you take risk premium in your business. Risk premium for the risk taken. In the business, you take more risk. Suppose you take a 4% risk. So what is your required rate here? Here your required rate will be 9%. Similarly, in US, will the risk-free rate be same? No. Suppose risk-free rate in US is, let's say, 3%. And risk premium is how much? Risk premium will be same because the same business you're doing. So similar risk, business, this is business risk, 4% risk you're taking. So required rate will be 7%. Required rate will be 7%. You understand? That's what I'm trying to tell you. The required rate of return should not be used as it is. If you are doing foreign currency cash flow, you have to adjust the foreign required rate of return. Like this, it should be 7%. In the problem, what they tell? Indian person starting a unit outside India, Indian person, think from Indian cost of capital, he requires 9% rate of return. This 9% should not be used in discounting in foreign currency. You have this concept in FR also, in like lease agreements, even in Index 115, when you do present value, lease agreements, Index 116. If the cash flow in foreign currency, even in impairment it is there. If the cash flow in foreign currency, you should not use the same discounting rate. You should use the adjusted discounting rate. It will not be exactly 7% because of multiplicative model. Always you should do 1 plus 1 plus. Here only I will tell you. What is the formula? 1 plus risk-free rate in India into 1 plus 4% risk premium or whatever it is. Okay, I will give the formula directly. I will not spend time in giving it. So how do you calculate the adjusted rate? I'll write it here. I don't have space here. So this adjusted rate. What adjusted? Exchange risk adjusted rate. Discounting rate adjusted. Exchange risk adjusted rate. Not other risk. Exchange risk adjusted rate. Exchange risk adjusted rate. So it's going to be 1 plus whatever required rate of return. I don't have space here. I'll write in the next slide. So please write it there. So I'll just say exchange rate here. So I'll write here the exchange risk adjusted rate is given by 1 plus required rate of return in India multiplied by 1 plus foreign currency risk free rate divided by 1 plus local currency risk free rate. So what in this example, if you apply 1 plus required rate in India is 9%, that is 0.09 into 1 plus foreign currency inflation or interest rate, both are similar, risk free rate. Foreign US 3%, so 0.03. Of course, you should do -1 divided by 1 plus local inflation 5%, local interest rate 5% -1. So 1.09 into 1.03 by 1.05 -1. You will get 0.0692 or 6.92%. That's what is close to 7%, right? 7 there, 6.92. Why it's not equal? Mathematical model, multiplicative model. If I do simply the risk rate and all, directly you will understand. Okay. And how to remember this formula? Don't think too much. Easy. This is same as IRPT theorem, isn't it? But only thing is, it is reverse of IRPT. I mean, IRPT logically, but mathematically for simplification, it looks reverse. So for memory purpose, for shortcut purpose, think it is reverse of IRPT theorem. What is IRPT theorem? 1 plus local by 1 plus foreign. Put ulta, opposite, 1 plus foreign by 1 plus local. You get the answer. So this first method what we are discussing, cash flow in foreign currency, NPV in foreign currency, investment in foreign currency, everything in foreign currency. But when you do present value, the required rate of return should be adjusted rate. And adjusted rate is calculated like this. This risk-free rate can also be inflation rate. Can also be inflation rate. If you follow purchasing power parity theorem, what it is IRPT, you can also do inflation under PPPT, purchasing power parity theorem. Okay, so this is method 1 where you get cash flow in NPV, NPV in foreign currency, and then you multiply the spot rate, spot conversion rate, you will get the NPV in local currency terms. Okay. Now, if NPV in foreign, second method, NPV local currency, everything will convert. See, we have investments in foreign currency, you apply exchange rates. We have investment in foreign currency, you apply exchange rates. You apply exchange rate, you get investment in local currency. You have an interim cash flow multiplied by exchange rates. This is foreign currency multiplied by exchange rate. You get the interim cash flow in local currency, terminal cash flow in foreign currency multiplied by exchange rates. You get terminal cash flow in local currency. Then you get finally NPV, directly if you do NPV in local currency. So it's easy. Easy. What one challenge? What is that? Investment. Okay. Now in investment in foreign currency exchange rate. This is spot rates. This is spot rate because today cash flow. Interim cash flow. How do you calculate? Interim cash flow. How do you calculate? Which exchange rate? Interim cash flow is not today. It's year one, year two, year three, year four, right? Different years. I need a forward rates. And who do you know forward rate in advance? We will not know forward rate in advance. So here we are going to use forward rate using IRPT theorem. We will not know the actual forward rate. So we will do the theoretical forward rate using IRPT theorem. And this also, terminal cash flow also forward rate using IRPT theorem because risk-free interest or inflation in India, in US, use IRPT theorem. Theoretical forward rate can be calculated using theoretical forward rates. You apply the exchange rates, then you get all things in rupee terms, you get NPV, and here discounting rate need not be adjusted. This discounting rate adjusted will happen only here. In local currency mentioned, required rate of return, no adjustment. Required rate will be discounting rate, no adjustment. Required rate will be discounting rate. You will not have any adjustment here. And ultimately, both NPV should match. Both NPV should match. I would recommend you can go with the second method, but any method you can do. Ideally, some small difference will be there because of mathematical round of reasons. You take more number of decimal, answer will be accurate. But either way, you can follow any two methods. NPV will be same. If NPV positive, project should be accepted. NPV negative, project should be rejected. So, what is the two alternatives? In alternative one, the discounting factor is adjusted. In alternative 2, the forward rate is adjusted. So ultimately you understand the interest rate impact, inflation impact is given. IRPT factor effect given even in first method in the form of discounting rate. So exchange risk is adjusted in the foreign currency method. Here exchange risk is adjusted in discounting rate. Exchange risk is adjusted in discounting rate here, and here exchange risk is adjusted in forward rate. Exchange risk is adjusted in forward rate. So either way, the interest rates in two countries are given effect and NPV is calculated should match in both the cases. Okay, so this is the one more variety which you can see in from this chapter. Okay, there is one last variety. Do you have any doubts in this case? Because this is the most repeated one. This is previous also is repeated one, but this has quite a few calculations around it. That's why logical, if you have any doubts, you can get clarified. Okay. Last variety which you can expect is the surplus fund management or treasury management problems. Surplus fund management problems. Surplus fund management problems. Direct example only I'll give. For example, you have a head office in London. Head office in London. Okay, and let's say you are having some dollar surplus. You are having some dollar surplus. So this dollar surplus you can invest in three ways. You can invest in, let's say, they will tell you like you can invest in London. I mean, okay, in London you can invest, means you can invest in pounds, or you can invest in, let's say, USA or New York, that will be in dollars, or you can invest in something like France or Geneva, that is in Switzerland, where it is in euros. So you can invest in any of these things surplus, and ultimately you have to come back to pounds. Why ultimately you have to come back to pounds? Because you are a headquarters in London. So final answer is has to be in pounds. Okay. So if you go for the first option, what you're having now, first dollar, first alternative. Okay. You're having dollar. Now dollar should be converted into pounds. If you want deposit in pounds, then you have to convert it to pounds. So which rate will you apply? You are converting today rate, and therefore you are going to do spot rate, spot sell rate. To be specific, let's say spot sell. Dollar is converted into pounds, and whether it's right hand or left hand side, be careful. Multiply, divide. Depending on that, higher rate, lower rate can be confusing. Okay, so now you have pounds with you. This pounds will be deposited, and it will generate, this will deposit and generate pounds deposit rate. So dollar deposit interest, and it will mature at pounds only, of course. Now we want the ultimate answer in pounds, so you express it in pounds. Yes, the final inflow we want in pounds only, so final inflow is in pounds. So this is first alternative. Second alternative, you have to deposit in dollars. You're already having in dollars, so no need to convert. So dollar will be deposited today itself. You deposit dollar, and dollar interest will come, and dollar will be matured. But you can't stop at dollar. You have to convert it into pounds. So how do you convert it into pounds? You are going to use forward rates, forward rate, and forward sell rate, of course, dollars to pounds, forward sell rate, convert to pounds. Then you have the inflow in pounds. Did you get the first method? You are in dollars, you deposit in London, so dollar you convert it into pounds, and pounds you deposit, it will generate interest and maturity will happen. But if you want to deposit in dollars, then what do you do? You're already having dollars, you deposit dollars, and that will get matured in dollar terms, but that has to be converted into pounds. Final answer should be in pounds. Therefore, I'm going to enter into a forward sell rate on dollars. Forward sell rate, I mean forward sell dollars, I get pounds. Forward sell dollar, I get pounds. That is my inflow under this alternative. Third alternative is interesting. I have dollars with me, but I have to deposit in euro. So from dollars, I have to sell, spot sell. I have to sell from dollars, I have to convert it into euros. Then euro deposit will happen. Interest you get, and this will mature at euros, but final answer I cannot keep it in euros, I have to convert into pounds. So from euro you convert it to pounds, it's going to be forward sell rate, forward sell euro, because from euro you have to convert it to pounds, and ultimately you have inflow in pounds. So wherever inflow is highest, that option is selected. Wherever inflow is highest, wherever inflow is highest. Okay, and sometimes will be one more area. They will tell you opportunity cost of dollars, something like that. They will give you, if they give you. For this dollar surplus, if there is opportunity cost, for this dollar surplus, if opportunity cost is there, then you treat like a dollar borrowing. You treat, you for solving problem purpose, treat like borrowing in dollar. Treat like borrowing in dollars. So in each option, what will have? Inflow in pounds is okay. Inflow in pounds is okay. Inflow in pounds is okay. In each of the option, you do outflow in pounds. Dollar, you have to repay dollar, and dollar you multiplied by the spot buy rate of dollar. You have to repay the loan using pounds. So you're treating this like a borrowing loan. You have taken a loan in dollar terms. The dollar you convert into pounds after this maturity period in all the three options, and that will be your outflow in pounds. You calculate the net profit, net gain, and wherever gain is highest, that alternative will be your recommendation. So this is one more kind of question that you can expect in surplus fund managing problem. Just be careful about this. If dollar had an opportunity cost, you treat like a borrowing. You treat like a foreign borrowing. Foreign borrowing, what you do, that's the process we will apply. Okay. Okay. This is the overview and different variety of questions that can be asked from this chapter. Very good. And here you should be careful. Sometimes cross rate prompts also can be there. Just be extra careful.